Each day I cover these very important 8 charts. They tell us a story about the health or otherwise of the main financial markets. With the banking crisis, we saw a flight to safety into the bond market which absolutely and utterly crushed yields. And also, it didn't do too well for the DXY, the US dollar currency index. We saw gold and crypto be major beneficiaries of the weakness in the financial system. The weakness in the financial system is also showing up in terms of the descent of oil. One thing to note, we haven't had any sizable spike in the VIX, even though it's crossed resistance. When we look at junk bonds and high-yield corporate bonds, they haven't actually broken their support levels, but they're looking quite weak. The market is in a real state of flux. The bailing out of banks and the money printer being turned on by the Fed is flowing through to the equities market. But we're seeing a lot of nasty signals, so we must be cautious, but we also must look for the opportunities. Steve Diggle, who made $2.7 billion in the GFC, is currently sitting on the sidelines. He's in cash, waiting to see how the markets unfold. One critical thing that he and other professional institutional investors and traders are looking at is the structure of the S&P 500. And there's quite a bit more to it than that, but the SPX is very important to understand. As we look at the S&P 500 here, what do you see? Without the CTKS method, you can't see where objective dynamic market structure actually is. Are we, for example, at support? Are we at resistance? What have we done? How far do we progress? Are we seeing a retest? What is actually going on? Let's dig in. Most retail investors and traders look at simple moving averages such as the 50-day, the 100-day and the 200-day SMA. What do these SMAs or simple moving averages actually do? The 50-day simple moving average is just literally the price for each of the 50 days added together, divided by 50, and we can see a little bit of a trend here. What does this actually do for people? Well, it doesn't tell them where prices could fall to. But a lot of people would say, no, Ken, the 200-day moving average, that's what catches price. We've seen in many sell-offs, the 200-day moving average does not catch price. Objective dynamic market structure does. This is very well known to members of our global community, and if you're new here, a very warm welcome. What we need to do right now is to look at the S&P 500 from a stance of short-term resistance. With the price increase from this structural level of support, and we know this is a high structural level, there's a lot of strong buy levels between 38.78 and 39.39. We can see that we just did a bit of a rally up, but did we cross over primary resistance or secondary resistance? No, we don't. No, we didn't. Not even close. What does this actually mean? Until we get away from this resistance, that means the price needs to trade above this resistance. Hopefully it gets above 40.65 and into this 4100 area, but there is structural resistance at play just in that area too. The S&P 500 is holding strong because of all the objective dynamic market structure underneath these support levels, and they're measured through Stanfield zones, which are accumulations of SLs or Stanfield levels. It's very important to mark up your charts with the CTKS method. You'll get X-ray vision as to where the algorithms are buying and selling. We also need to pay attention to the US dollar. The Fed liquidity boost is bad for the dollar. Deutsche Bank's Ruskin says, how is the US dollar holding up? You can see it's been coming down severely. Why has it been coming down severely? You've seen the rise in bond prices and the escalation in the sell-off of bond yields. This is all playing into the stability of the financial system. The DXY shows confidence in the financial system. It's a little low at the moment. But when we look at the DXY, what are we actually seeing here apart from a lot of negative momentum? Where is the objective dynamic market structure? Where are the algorithms stepping in to buy and to sell? We can't tell from this chart. But we can tell when we mark up the chart with the CTKS method. I've been saying for quite a while now, there's major support between the 102.991 and 103.178. That's just below the current value of the DXY, which is 103.305. The loss of confidence in the financial system has been bleeding out of the equities market into gold, into Bitcoin, and into bonds. Currently, there's a flight to safety by smart money. And when we look at Bitcoin against the DXY, you may say, oh, that's pretty interesting, but I'd like to show you something specific. I'd like to show you what I see. I see that the directional movement of the DXY and Bitcoin are coming into alignment. You'll also notice that the DXY currently has a lot of positive air above that smart money buy area. It's very, very possible that the DXY could get over resistance and start to come back. What is that going to do to Bitcoin? You can see Bitcoin has been moving in inverted relationship with the DXY. If the DXY goes up, what do we expect Bitcoin to do? Please let me know in the comments. And of course, where could that likely stop? Around the 103.827 mark is quite a bit of structural resistance. This particular band here between 103.714 and 103.883. But if we see the DXY getting rid of that structural resistance and turning it to support, that would be very bad for gold, bad for Bitcoin, and bad for the bond market as well. That means we need to look at gold. Gold is currently trading at 1978. And what did we see here? Gold absolutely blew up and then got rejected. Poor old gold, it feels very rejected at the moment. The key to understand, an objective dynamic market structure rejected gold. What was it? We can't tell with normal technical analysis methods. Only the CTKS method will tell us. It tells you where the algorithms are stepping in to buy or to sell. And we can see that there was a really large ramp up, which would have called a lot of retail traders and investors in, but it struck a level of market structure which caused this sell-off. Remember, sharp angles tend to, please let me know in the comments. There are a variety of different market structural levels on gold, and we were talking about the 1970-1980 mark, as well as the 2014 to 2025 mark. There's a lot of overhead structure that's actually going to suppress gold down. Have a look at this just to get an idea of where the smart money is going to come in and say to gold, not so fast. One thing that the CTKS method does, it helps you to identify risk areas inside market structure, which is a very powerful thing to do. What actually happened when gold rallied and couldn't get through the 2000 and around the 2006 resistance? It came back and retested the 1980 and 1970 levels, and now it's ping-ponging between them. This is a very powerful thing to understand. When you actually enforce a level and get through it, the next level opens up. When you get through that, the next level opens up. When you get through that, the next level. If you don't, the bottom level and the bottom level. Look at that big sell-off in gold. That would have caught a lot of people by surprise, but not anybody that's marked up their chart with the CTKS method. They wouldn't be caught by surprise at all. They'd be expecting it. A lot of people would have thought the price would come down and down and down and down. Not so. It actually hits objective dynamic market structure and slows down. If it goes below, it's seeking to either consolidate and rebound or consolidate and drop off down towards the next market structure level. A very interesting thing to look at is the SPX, or the S&P 500 versus gold. And here we're looking at the S&P 500 futures. When you see this particular relationship, I don't look at it this way. I look at it very differently. I'll show you how I see this relationship. I see it like this. I see that the inverse S&P 500 futures are actually giving us a fairly good signal for the direction of gold. What does this tell you about what the market is saying about gold's direction? Please let me know in the comments. And why do I ask you to respond in the comments to things like this? It's all about active learning. We know that we control the trade or investment, but it's the market that controls the return. I'm always seeking to increase your synchronization factor. It's very important to get into sync with the market, and to do so, you must look at a lot of charts. Don't just look at one chart. Looking at one chart will sink your portfolio. Don't forget, there are always lag effects with all of these overlays that you can see. One thing that we always bear in mind, it takes time for things to play out, but we can see the inverse S&P 500 is giving a bit of a directional signal to gold, and gold is not holding on to this 1980 level. And when we compare that against the S&P 500, we're starting to stack probabilities, and this is what stacking probabilities is all about. We knew that if we were in gold and actually looking at all this overhead resistance, it could come up and touch it, but it would be likely to get redirected down. But of course, we are not like retail investors and traders. We are professionals. We have three-dimensional thinking. We say, okay, there's some stacked probabilities that gold could have a bit of negative momentum behind it. But what if it just goes flat? And what if it reverses course and goes up? We're ready for that too. We don't hold on to one position inside the market. We hold on to three at all times. And we don't wait for a crisis to make a decision. We make a decision on the green days when everything is fantastic. And then we make a decision each and every day following that. If you do not have your decisions, especially at a time like this, all hammered out in advance, you'll be caught off guard and you'll be asking people, what do I do? You need to have the answer to that question for yourself, because only you can answer that question. Nobody else can do it. And just a little bit of a point, this CTKS method, these SCs or Stanfield zones, are actually marked up from 1883 price action on gold. If you would like to know more, you can go to the CTKSmethod.org. The link is in the description of this video. In other news, Amazon to cut 9,000 more jobs after earlier layoffs. And what were the earlier layoffs? They were 18,000 job cuts. What does this mean? The big end of town is actually raising the unemployment rate. And when the unemployment rate spikes up, when credit spreads spike up, when the VIX spikes up, it doesn't bode well for financial markets. The critical thing to understand, the S&P 500 has so much objective dynamic market structure underneath it that it's finding it hard to go down. But if it goes down, it's going to drop like a brick. Have we seen this in other times in history? Yes, we have. We must pay a lot of attention to objective dynamic market structure. It's money in the bank or money out of the bank, depending on if you're looking at it or if you're not looking at it. And when we look at the VIX, around March, over the past 20 years, the VIX has historically spiked up, and it also spikes up in October. If we do get a spike in the VIX, that seasonal spike, and we're looking at credit spreads, a measure of risk inside the financial system, they're spiking up. They're definitely over resistance. This is not a good look. This is what we don't want. And we know the unemployment rate is starting to spike up as well. Again, things that don't bode well for financial markets. But we always position ourselves to take advantage. It doesn't matter what the market's doing, we're just stacking probabilities. We're always in the market, but we're cautious how we do things. It's important to stack probabilities. US oil sinks below $65 per barrel to the lowest since 2021 amid the banking crisis. Now let's look back to 2020. One thing, before we do that, I just want you to know that oil has lost its short-term support level. That is not a good thing. That's not what we want to see. What happened in 2020 with the US liquidity crisis and of course the world getting shut down by COVID? Oil just dramatically sunk. And when it sunk, it brought so much difficulty into the financial system as well. You can also see that the unemployment rate started to spike and really spike. Credit spreads started to spike and then just took off exponentially. The S&P 500 was coming down and then it just plummeted. These are things that we need to bear in mind when you're looking at US oil. It's one thing in the charts that I talk about every day. But hopefully now, when you look at US oil, you'll have a much better appreciation for what this actually means. We do very deep dives inside the masterclass. Recent episodes have covered what happens to junk bonds and high-yield corporate bonds. I suggest at least the past week is very important to put on your radar in terms of the videos that we've produced here. They're absolutely and utterly jam-packed worth of quality information to help you to make better decisions, or at least get prepared. While the rest of the retail crowd is out there celebrating all sorts of things, you will be prepared. And that's what's most important, because when the markets turn around, they can be violent in their turnarounds. Policymakers and government will say nothing to see here. Everything is fine inside the banking system. But the charts don't lie. Look at the banking system. The top 15 US banks, they're all plummeting. When was the last time they plummeted? It was the C19 sell-off. Many are reporting that the Federal Reserve is in a no-win situation, and that's really true. If it increases the federal funds rate, it's going to throw more pressure on the financial system. But if it doesn't, if it just injects a huge amount of cash into the economy, it will rampantly increase inflation. So what is actually the smart money predicting that will happen with the next FOMC meeting, which is under 2 days away? You would think that the probability of the Fed raising interest rates would be 0. It's in fact 76.8% for a 25 basis point increase. Have you any idea of all the hell that could break loose when the street starts to understand what we've been looking at each and every day? Every day. And why are we so thorough? Because that's what you need to be as a professional. You have to look broadly. The major problems with financial markets, they don't trade 24 hours a day. The S&P is not operating 24 hours a day. It's just operating in its narrow window, just Monday to Friday. How slack is that? But one thing that we do see here, when we look at the S&P 500 and S&P 500 futures, they're giving us a bit of a picture. There was a bit of a crack that occurred in the past trading session where the S&P 500 futures dipped down dramatically. What happened to Bitcoin during that time? And then Bitcoin recovered, which meant that risk-on sentiment re-entered the market. And what did we see with the S&P 500? We've actually noticed that there's quite an association between the directional movement of the S&P 500 and the direction of Bitcoin. And we've seen a lot of upward momentum in the S&P 500 just currently. But we know it's still under 2 levels of very short-term resistance, but it does have a lot of buying support underneath it. It literally is a make or break moment in markets. If we look at price action like this, Where is price going to come up to next and try to encounter resistance and potentially get through it? Where is the next resistance level? Where's the next one? Where's the next one? Without the CTKS method, it's really difficult to see these things in market. But with the CTKS method, you can tell where price will start to get rejected. It will need to consolidate to go higher or even dip down below to challenge the next level. And we're starting to see a good bit of positive momentum inside Bitcoin. Does this mean Bitcoin can continue up? Definitely it does. Can this mean that Bitcoin goes down? Yes, definitely it can do that too, because we've got to stack the probabilities. A lot of people are just looking for a simplified answer. If you're taking advice from people with only one position, just run away from those people. You need 3 positions at all time. If you want to guard your wealth, that is. Where is the next structural resistance level and structural support level inside the crypto industry? Because we know Bitcoin is the undisputed ruler of the alts. If Bitcoin goes down, the alts are going to bleed. If Bitcoin goes up, the alts are going to rally. It's amazing how fast things can change inside a market. About a month ago, everybody was saying, oh, Bitcoin and crypto, that's for drug lords and criminals who launder their money or something like that. And now we're hearing on the mainstream media news, Bitcoin as a viable alternative to the banking system. This is, of course, going to pull people across to crypto. And it's pulled people into gold as well and into bonds also. The next major resistance level is between 29,930 to 30,221. And we can see that Bitcoin is currently 27,940. We need to bear in mind that if Bitcoin gets above this resistance, it could cover this space rather quickly because there's not any resistance in there. If we go back to talk about what happened with gold, you saw gold spike up and then lose a level and spike down quickly because there's fresh air or no support under a particular price means it can move down quickly. What if the dollar starts to rally because it's got some fairly substantial support underneath it and it's been holding up with positive air? What happens if that happens? Well, that's going to be a very, very interesting thing to see. We would expect negative price momentum on gold and Bitcoin and crypto. This is why it's so important for you to actually understand how these different charts all hang out together. One rule that is near and dear to our hearts is Rule 621. Buy on red, sell on green. That is what Borsog means. And you can see the Borsog eagle screeching in the background. Borsog is a very difficult skill to acquire. It takes a different mindset. Most of the time, when people see red, they sell. When people see green, they buy. That puts you on the wrong side of the percentage in both directions. You don't want to do that. Instead, you want 3-dimensional decision making. Know what you will do with your trades and entire portfolio if price moves against you, goes nowhere, or goes for you. And Rule 130 is very important to do that. Make volatility your best friend. We are notorious in the market for going in on bleeding red days and making profits by going long. This is not a skill that a lot of people have, but it's the professional trading mindset that we're all about. Making money when the markets are green, pretty much anybody can do that. But if you can make money when the markets are bleeding, you're something else. And that's what we're focused on inside our community. And we don't use any leverage. We don't use derivatives. We don't go short, because when you go short, you can lose much more than you put on. The Masterclass has a very specific focus that we do. We understand if we don't have the knowledge, we're just gambling. And if we're gambling, the house will always win. We have our foundations. We know what we're doing and we have the skills. then we look beyond the crypto market into the stock markets and into world events. We need to know what type of sentiment exists in the market, and we need to look at the charts to prepare ourselves. Then we come back inside the crypto market, finding the market's focus, understanding opportunities reset daily, and enhancing our pattern recognition. And of course, you can apply all of this to Forex and the equities markets, and also the bond market if you wish. But before we buy or sell, and there's so many ways of doing that, we must master emotional control through positive excellence. This method is all about knowledge transfer from 30 plus years inside financial markets, and it's available through the MC or the Masterclass. As we've seen time and time again, Rule 225 from the MC is very important. Bitcoin cannot escape the stock market's gravity. If the stock market crumbles, expect Bitcoin to get caught up in that gravitational pull. There's definitely been a flight to safety inside the crypto market into Bitcoin, but we look at the alts to see if Bitcoin's strength will be retained or if it's weakening. Now we're going to go through the top 8, and I'm going to ask you a question that's really important for you to answer. Please let me know in the comments what your answer is. When we look at Bitcoin right now, it's looking good. It's just trying to get above that smart money sell area, and you know that because we've looked through this particular analysis. We understand what's happening with Bitcoin, but I want to layer into your knowledge. Look at what is happening to Ethereum at the moment. Look at that, it's breaking down. Ethereum is literally, if Bitcoin swap with Ethereum, Bitcoin's price would be down here. That's interesting. What about BNB? What do we see with that? It's at that secondary level. It's down here as well. Note that Bitcoin is up higher. Both Ethereum and BNB are lower. I'm not going to talk about the stable coins just at the moment. What about XRP? Look at this. It's not looking good. Look at that weakness. What about the weakness in ADA? That's also very weak. And Matic is showing a dramatic amount of weakness. What does this tell you about Bitcoin's rally? It's very, very important that you answer this question. Let's do a thought experiment and go a little bit further with that kind of analysis. Look at Bitcoin's fingerprint and look at Doge. What is Doge doing at the moment? Is Doge going up like this, like Bitcoin is doing, or is it going some other direction? It's pretty clear from the chart what Doge is doing. It's showing a lot of weakness. What about Solana? Is Solana pumping up whilst Bitcoin is pumping up, or is it coming down? It's coming down. I'll just leave BUSD and the DAI stablecoins. I'll leave those. Let's have a look at SHIB. What is SHIB doing? It's inverting this relationship. Whilst Bitcoin goes up, SHIB is coming down. You can see the alts are under pressure. What about Tron? Tron is coming down. What about Litecoin? Litecoin is coming down. What about AVAX? AVAX is coming down. Now we've looked at the top 16. We need to make a decision. What does this actually mean? That's why when you do your active learning, what you're actually trying to do is trying to understand the market from your own perspective. Don't worry about right or wrong. We either win or learn, but we never blame. The beautiful thing about our global family, we're a learning community. You'll see it in the comments. Everybody is learning and supporting each other. It's just a beautiful place to be. We literally have one of the best communities on YouTube, and I so appreciate you sharing this time together. There's always something fascinating happening in the crypto market. When we look to the top gainers in the past 24 hours, top 100, XDC, Nexo, EGLD, Synthetics, Solana, and then FEI, EOS, and USDP. The top losers of the top 100, Immutable X, Conflux, AGIX, DYDX, Render, Optimism, Phantom, and Mina. You will see that some of these names rallied really strongly, and now they're rallying really strongly in the opposite direction. Yesterday, we looked at AGIX and it was one of the greatest losers. When we look at price action like this, it's really tough to figure out what is going on. We do not know the objective dynamic market structure. We do not know where the algos will step in and step out of the market. But with the CTKS method, it's like the light coming on. Our beloved Beardy said it really well in yesterday's video. When Ken took off the Stanfield zones on the AGIX chart, it was like the lights were turned off and then poof, the lights were turned back on. I can't imagine trying to trade right now without the confidence I built up using SLs and SCs. Have a great weekend, everyone. Or have a great week. Should be an interesting opening tomorrow. Thank you, Beardy, for your comment. Without the CTKS method, people get into story-based analysis or SPAs or recent indicative price which RIPs your money. With SCs and SLs, we know where the objective dynamic market structure is, and when we look at AGIX, we can see that we lost that smart money buy area. It's now turned into resistance. What does that actually mean? Well, we can look down and see that AGIX next level of support is all the way down here. I'll put a percentage on that. The next level of support is literally about 14% under the specific price of AGIX, which is currently 45.78. Without the CTKS method, you just wouldn't know where the algos are going to come in and support price or going to come in and sell price down. Crypto is so incredibly volatile that it's really important to understand where those levels are. Someone you know found that the Masterclass changed their life and has very generously offered a CTKS partial Masterclass scholarship. To apply for the scholarship, the link is in the description of this video. You can find out all about the Masterclass at CryptoTechnicalAnalysis.org. The focus of the Masterclass, if you come across to testimonials, it's all about the transfer of knowledge. And if you would like to read some of the feedback that people have very kindly offered, you can go through and have a look. There's a lot of people that are very happy with the Masterclass, and I always make sure that I keep the knowledge updated. And if you're a Masterclass student, please watch the daily videos. It's absolutely crucial for you to do. The CTKS Masterclass is a premium Rolls-Royce level masterclass on crypto technical analysis using the CTKS method. The CTKS method was invented by myself through my more than 3 decades of experience in financial markets, but also coming from an actuarial background and also being a former lecturer in first and second year statistics. The CTKS method is a method of technical analysis invented specifically for crypto that accounts for exponential implosions and explosions in price and updates normal stock market and forex technical analysis. You can see just how powerful the TA that we do is. We reveal where the smart money is stepping in and buying and stepping in and selling. And when you look at the S&P 500, that's the reason that the S&P 500 hasn't sold off, because it's at such strong buy levels. My goal is for you to become your own financial advisor, to have the skills. This one's getting a little long, but I thought it was very important to give you more of an insight into what's actually happening inside markets, so you can get into synchronization and also do your 3-dimensional risk management. Have a great day or night ahead, my friends, and Kate and I will look forward to joining you again tomorrow. Bye for now.